Hey everyone, this is Gene Goldman. I'm the Chief Investment Officer for Cetera Financial. We work with the Wild Wealth Management Group to help support you and support them in terms of markets and the economy. So I know I've talked to you a few times. What I want to do today is talk for maybe 15 or maybe 20 minutes to talk about all about the Fed and really our market perspective. So our market perspectives are really about the Fed and the fact that the Fed is in a pickle. Before we dive into the Fed, I want to remind you our three themes that we laid out at the beginning of this year. Number one, the Fed stays aggressive. Number two, a policy error is likely. And a policy error is like a fancy way of saying a recession. And we do believe, unfortunately, a recession is coming, but good news, we'll talk about this later. We do think if we have a recession, it will be mild. And third of all, expect these big swings in market volatility. So again, three themes for this year. Fed stays aggressive, a potential recession, and market volatility increases dramatically. So if you look at the slide, if you kind of take those three themes and kind of tie it to where we think the markets are going to go, we sort of have this sort of tale of two cities. The first part of the year, we do believe it's going to be a little tough for the markets. We do believe because the aggressive Fed potentially pushing us into a recession, the fact that valuations are pretty high in the stock market, and the fact that earnings are a little too high and they need to be revised lower will pressure stocks in the first part of the year. But the good news is that in the second half of the year, we do think we'll be in a better place. Lowered expectations help to create the opportunity to beat these lowered expectations. And I'll talk about that a little bit later. Number two is that we'll see some clear signs of disinflation. There should be some really clear signs, especially in July and August, that the measures that the Fed has done, raising rates, for example, will start to push inflation down even further. And then lastly, as I alluded to earlier, is that if we have a recession, and the odds are pretty much for a recession coming, that this recession will be pretty mild. So let me dive into these. So the question is, why are we so cautious in the first part of the year? And again, I laid out the reasons: high valuations and earnings, and the fact that we're likely headed to a recession. And I know you're probably looking at me thinking, wow, market will be weak in the first part of the year. But didn't we have a good first quarter? And the answer is yes. The S&P 500, as we talked about this before, is a very broad-based benchmark which measures U.S. stocks, was up about 7.5% in the first quarter. Pretty good number, right? But that market, that return was not as strong as it seemed. First of all, if you look at this slide, and remember the slides, horizontal is time and vertical is the index. What this slide shows, it shows the S&P 500, that index we talked about. And for probably the last 6, 7, 8, 9 months, it's been in this range between 3,800 to 4,200. So stocks have been sort of range bound in this level. And really what's going on is the stock market is saying, we're trying to figure out what the Fed is doing, what is going to happen on a go-forward basis. Lots of uncertainty. And if you think about the fact, again, the S&P 500 was up 7.5% in the first quarter. But here's an important point. It wasn't a very healthy market because only 10 stocks drove 87% of the return. So let me say this one more time. It's so very important. The stock market did really well in the first quarter, but this was driven really by 10 stocks, which drove 87% of the return. A narrow market like that is not a very healthy market. If you look at the markets in the first quarter primarily took their direction from the 2-year Treasury yield. So if you look at this slide, I plot two things. The light blue line is the S&P 500, again, that broad benchmark, and the purple line is the 2-year Treasury yield. And what you see is that these two move inversely. So if you look at the red arrow, that's the S&P 500 going higher. Purple arrow is the 2-year Treasury yield going down, going up, going down. What you see is that these two are pretty inversely correlated. So why does the stock market care about the 2-year Treasury yield? Well, as we've talked about before, the 2-year Treasury yield is an amazing proxy of what the markets think that the Fed funds rate will be 1 year from now. And as a reminder, the Fed has lots of monetary tools at their fingertips. Their primary tool is the Fed funds rate. This is that rate where if the economy is going too fast, they raise it to slow the economy down in order to slow inflation. If the economy is going too slowly, they lower the Fed funds rate. And by lowering the Fed funds rate, borrowing costs come down, home mortgages come down, home equity loans come down. So this theoretically stimulates the economy. So what you see again is that every time the 2-year Treasury moved higher, because the market is saying the Fed is going to be raising rates more, the S&P 500 fell. Every time the 2-year Treasury fell, when the market is saying the Fed is not going to be as aggressive as we anticipate, the S&P 500 moved higher. So again, very inversely correlated. The markets are following the 2-year Treasury yield because it's a 1-year proxy of where the Fed funds rate will be 1 year from today. So with that said, let's talk about the Fed. Why does the market care so much about the Fed? And if we take a step back, I know we've talked about this before, but the Fed has a dual mandate. And the dual mandate is they want to make sure we all have jobs. They want to maximize employment, but at the same time, they want to make sure that inflation is kept in check. So maximizing employment, they've done a great job. We all have jobs. We've got about 3.8 million more jobs out there than people looking for jobs. There's plenty of jobs out there. Inflation is what worries the Fed. Inflation is too high. So the Fed, what they're doing is they're raising interest rates in order, as I said before, to slow the economy down so we won't buy as much. This reduces inflationary pressure. If you look at this slide, let's just talk about the Fed and how aggressive the Fed has been. So what I've done here is I plotted the Fed funds rate. Remember that tool the Fed uses to raise rates and lower rates. You see over the last 3 or 4 rate hike cycles. The first red arrow in the middle of the page slide basically shows that in the last rate hike cycle, it took the Fed about 3 years to go from 0 to 2.5%. So it took them 3 years to go from 0 to 2.5% in their interest rate. In the current rate hike cycle right now, the one that started in March of 2022, it took the Fed 6 months to go from 0 to 2.5%. So let me say this one more time. It's so important because this shows you how aggressive the Fed is. The last rate hike cycle from 2016 to 2019 took the Fed 3 years to go from 0 to 2.5%. This time, it took them 6 months to go from 0 to 2.5%. This shows you how aggressive the Fed is. And if you read what's called the Fed dot plot, and this is basically called the summary of economic projections, this document that the Fed produces once a quarter, the Fed has basically said that the Fed funds rate, this interest rate, is going to go to 5 1/8, where it is today, and stay there for the rest of the year. So again, the Fed is saying we're going to keep rates where they are today and keep them all the way until the end of the year. The markets are saying, hey, Fed, we don't really believe you. We basically, as the markets are saying, no more rate hikes. And then you're actually going to cut rates by 2 or 3 times. So cut rates to about 4.5%. This slide shows the implied Fed funds futures. And basically, this is just mathematics and market mumbo jumbo. But basically, what it means, it takes all the data out there and says, based on the data out there, this is where we see the Fed funds rate being at the end of the year. So the market is saying at the end of this year, Fed funds rate, that big interest rate the Fed uses, will be at 4.5%. The Fed is saying, nope, it's going to be at 5 1/8. There's a big disconnect between the markets and the Fed. So why is that the markets don't believe the Fed? And there's 2 key reasons. Number one, economic data is slowing pretty fast. Basically, the markets are saying, we know that you push us into a recession, and you see the data already. You can look at manufacturing, you can look at housing, you can look at auto sales, you can look at some recent weakness in retail sales and consumer spending. The markets are saying, all the data out there is suggesting that we are going into a recession. And if you look at this, this is from what's called our Recession Riskometer. This is the chart book that your advisors have access to. This shows all the data out there, the pages and pages of economic data. And it's busy stuff. It's lots of busy data. But if you look at the lower left-hand side, we take all the data and we squeeze it together and create a recession riskometer. And you can see that the data is screaming, we're headed towards recession. If you look at a little bit to the middle of the page, you see the economic trend signal is starting to weaken. Again, the data is slowing down pretty quickly. So number one reason why the markets don't believe the Fed is that the markets are saying, you, Fed, you pushed us into a recession. We're headed towards a recession. And the data is going to start to slow down. And the market is saying, Fed, we expect you to cut interest rates. The other reason, and it's actually sticking with this reason, if we do have a recession, one question we get from a lot of you is, well, when is the recession going to happen? I mean, is it happening today? Is it happening later this year? And there's 2 things we can look at for clues in terms of when a possible recession is. The first clue is simply saying it takes about 12 to 15 months for a rate hike to be felt by the economy. So the Fed raised rates beginning in March of last year. And if you pull the calendar ahead 12 to 15 months, you're saying maybe the second, maybe the third quarter. If you look at the month of January this year, January's data was pretty strong because we had a very warm winter or a very warm January. So therefore, we as consumers, we spent less money on heat, and instead we spent more money on consumer goods, TVs and cars and whatever we wanted to buy. So the economy was pretty strong in January. Because of that, we do believe that the economy had some momentum going into at the end of the first quarter and early in the second quarter. So our best guess is possibly the third quarter for a recession. So again, it takes about 12 to 15 months for a rate hike, the Fed raising rates to be felt by the economy. And you pull the calendar ahead 12 to 15 months, maybe the second, but most likely the third quarter of this year. Another data point you can look at is what I show you here. It's called the Leading Economic Index. And what this simply is, it's 10 high-frequency data points. It's very real time for the economy. It looks at like average hours in manufacturing, jobless claims, manufacturing new orders, building permits, these really high-frequency data points. And what this historically has shown is that when the Leading Economic Index, it tends to peak about 13 to 14 months in advance of a recession. And you look here on the right-hand side, this index has fallen nearly every month since February of last year. So this index suggests that maybe the second or third quarter we have a recession. Our expectation is that the recession most likely appears in the third quarter. So again, number one reason why the markets are not believing the Fed in terms of interest rates is a potential recession, likely in the third quarter of this year. The second reason why the markets don't believe the Fed is the feeling that basically the Fed broke something. There's this old adage out there for markets, and the adage is bull markets don't die of old age, but rather they're killed off by the Fed. And this makes total sense. The Fed makes so many mistakes. If you look at the last 15 rate hike cycles, remember the little humps I showed you before with the Fed raising rates? In the last 15 of these rate hike cycles, the Fed has pushed us into a recession in 11 of the last 15 because they either raise rates too fast or they're too slow to cut rates. The feeling today is that the Fed finally broke something. And a key example is the banking crisis that happened in the middle of March. And as a reminder, think about what the Fed was doing. The Fed was raising rates dramatically. And when they raise rates dramatically, I'm not going to go into treasuries and government bonds, but think about this. When yields move higher, so interest rates are moving higher, bond prices decline. It's basically mathematics around bonds. Yields higher, bond prices come down. So a lot of banks held safe US treasuries on their balance sheet. But the problem is that as interest rates are moving higher, the value of these treasuries, which are safe, which are guaranteed, or which are backed by the US government, their value declined. So banks made some mistakes because they went and they started investing in longer term treasuries, which has higher duration, which basically means higher interest rate sensitivity. So as yields move higher, this moves down faster. What these banks should have done is that they should have invested in short-term treasuries where, yes, when rates move higher, bond prices won't move down as much. But we will spend years discussing this in economics and investing 101. But basically, long story short, the Fed raises rates, bonds held by banks fell in value. The second reason that why the Fed kind of broke something is what you see here. What you see here, I'm showing two lines. The purple line are money market assets. So basically higher yielding money market assets. And the light blue line that's rolling over, those are deposits at banks. If you're a depositor at a bank, what are you seeing? Well, money market yields are moving higher. I'm going to move my cash out of my bank, out of my savings account into a money market fund. This basically saw money moving out of banks. So why is this a big deal? Why is it when treasury yield prices come down and deposits leave banks? Well, the important point is that you take all this together, what's going on at banks is that banks are getting worried about the environment. Let's say that you're Gene Goldman Bank, you're a safe regional bank out there, and you and I have done everything correctly. We've lended correctly. We're not taking the interest rate risk where we're investing in long-term treasuries, and we've done everything perfectly. You and I know that as a bank, a regulator is going to knock on my door and say, we saw what happened at those other banks. Let's look at your statements. Let's look at making sure that you are doing everything you're correctly doing. That's one reason. The other thing to think about is that as you as a bank, as Gene Goldman Bank, I'm worried about deposits leaving to going to money market funds. So I start to raise the amount of the interest rate that I pay my depositors. I pay you as a savings holder. So you take all this together, and I know I'm getting into the weeds on this, but this is so important. You take all this together, the result is that banks are tightening their lending standards pretty fast, pretty quickly. You see here, this red arrow shows that in the last quarter, banks are dramatically raising lending standards, whether it's a commercial loan, an industrial loan, a loan to a small company, a large company, mortgages, lending standards are tightening dramatically. So you take tighter lending standards. So basically banks are saying, we want to focus on our our highest credit quality customers. So they're tightening lending standards. And then at the same time, you look at this slide. This slide shows that the supply of loans is also declining. Basically, loan demand is falling. So you've got supply of loans falling via tighter lending standards. You also have loan demand falling too. So you take both of these together, lower loans available, lower demand for loans, this equals a potential credit crunch. So if you kind of flow through this whole scenario, a credit crunch means it's more difficult to borrow money. This leads to a potential economic slowdown and a potential recession. So this is the second reason why that the markets don't feel that the Fed will not raise rates as much as they say. The first reason, we go into a recession. The second reason is the markets believe the Fed finally broke something, as they've done for so many rate hike cycles. So clearly, you think about right now is the Fed. Remember I talked about the Fed's dual mandates? The first mandate is that they want to make sure we all have jobs. The second mandate is that they want to make sure that inflation is kept in check. And when the Fed really starts to, when they start to sniff a recession, like they are starting to right now, when they start to say, we smell a recession coming, historically what the Fed does is that they start to cut interest rates. This makes sense, right? They cut interest rates to stimulate the economy. And we're seeing data right now suggesting a recession is coming. But the problem is, if you look at this slide, global inflation is still too high. Yes, it's rolled over. Yes, it's slowing down pretty fast, pretty quickly. But domestically, the Fed has a target of 2% of inflation. And you look at this slide, and this slide shows inflation levels at different countries all over the world. Inflation is still well above that 2% target. So the key point here is that, yes, a potential recession is coming. Yes, historically, the Fed will cut rates as a recession shows up, but inflation is now a constraint to the Fed. The Fed really can't cut rates, even as the economy is slowing down. So you have the whole predicament. So again, the first concern, again, why we think the markets will be a little volatile and uncertain in the first part of the year is that the Fed has aggressively raised rates, likely pushing us into a recession, but the Fed is in the predicament because they really can't cut rates since inflation is so high. The second reason why we are worried about the markets or concerned about the markets is just valuations. So if you think about this, and I know we talked about this before, people in my shoes, we look at what's called the price earnings ratio to determine if stocks are cheap or if stocks are expensive. So the price earnings ratio, the PE ratio, it's a price of the index. So let's just say the S&P 500, the value of it, divided by the earnings within the index, price earnings ratio. If it's higher, stocks are more expensive. If it's lower, stocks are cheap. And historically, you look at the average here, and the average here shows that stock market PE or price earnings ratio is about 15 to 16. Today, the price earnings ratio is about 18.1. It's a little high, but the problem is that it's pricing in absolute perfection. And the only way you can have a valuation this high is if interest rates are lower, which they're not, is if inflation is lower, which is not. So again, valuations are pricing in absolute perfection, and they're pricing in much lower interest rates and much lower inflation. And just as a case in point, if you look at those red circles, this shows the last time the PE ratio of the S&P 500 was at these same current levels, inflation and interest rates were much, much lower. Valuations are pretty high, and that's what we're worried about. So number one, the Fed makes a mistake, pushes us into a recession. Number two, valuations are pretty high, pricing in absolute perfection. And the third reason, and we've talked about this before, is earnings. Corporate earnings are a little bit too high right now. So if you think about investing 101, earnings drive stock prices. So we learned as companies generate more earnings. If they generate more earnings, what happens is that investors like you and I, we get more attracted to those stocks because earnings are moving higher. Those are, I'm making assumptions, but those are better stocks as earnings move higher. What we've seen though, and this chart shows this data, is that earnings have been slowing down pretty quickly. So if you look in the purple and the light blue line, you can see it's getting smaller and smaller and smaller. Earnings have been revised dramatically lower. For example, if you look at the peak of earnings back in June of last year till today, earnings are down about 13% from their peak. Historically, when you have a recession, earnings fall about 19%. I know that's an average number, and averages can mix up some of the data, but basically earnings have fallen 13% since their peak. And historically, they usually fall about 19% during a recession. we do think that earnings are going to be lowered even further. GDP is slowing down, employment is slowing down. You look at the financials like banks need to raise interest rates to secure deposits. All this together really pressures earnings, and we do think earnings are going to be revised a little bit lower. Our best case scenario, or I guess our key expectation, is that in 2023, we expect a very mild recession, but a very much of a scenario like we saw in 2001. So if we go back to 2001, I know it's a long time ago, it was 2 decades ago, but if you go back to 2001, the prior 2 years, we had Y2K, we had the tech bubble. In those time periods, what we saw is that analysts dramatically revised their earnings estimates in order to take advantage of Y2K and the whole tech bubble. Then we had a mild 2001 recession, sort of like what we envision today in this year, a mild recession. And then afterwards, earnings get revised to pre-Y2K levels. Similarly, in this situation, we do believe that earnings were revised dramatically higher for companies today due to working from home, basically pulling forward earnings to the present. Then we have a mild recession this year, and then we do believe earnings will be revised back to like 2019 levels. So this is our scenario that we think will play out in the next throughout this year. So again, we're a little cautious in the first part of the year. Number one, the Fed made a mistake. Number two is that valuations are pretty frothy right now, pretty expensive, pricing in absolute perfection. And number three is that earnings are a little too high. Whew, let me take a deep breath. Okay, that's just the bad news. Okay, let's talk about the good news, because I'm not a pessimistic person. I'm a good news person. The second half of the year, we think it will be a better year for the market. And there's 3 reasons why. Number one, lowered expectations. So all these concerns about a potential recession, about high valuations, about earnings need to be revised lower, it's a lot of pessimism in the market in our expectation. And what happens is that expectations start to come down. Market expectations start to come down when people and investors say, well, it's not going to be a great year. We do believe these lowered expectations, that the good news is that in the second half of the year, the expectations are so much lower, is that they'll be easily beaten, they'll be easily exceeded. So we believe in the second half of the year will be a much better year because expectations are so low, they get easily beaten. The second reason is just disinflation. We do believe the Fed will be successful to lower inflation. The Fed has aggressively raised rates. This is slowing down demand pretty fast, pretty quickly. Also, if you look at some of the key commodities, they've come down. Food has peaked in price. I think at last point I checked, eggs are down 45% year to date. Energy prices have peaked. I think the barrel, an average price for a West Texas Intermediate crude is around $70 per barrel. Energy has peaked. If you look at small businesses, back in November of 2021, 54% of small businesses said they were raising prices. Today, it's only 21%. So again, companies are not raising prices as much as they did just a couple of years ago. And then rent has peaked. I know CPI rent, and you see rent is pretty high. You hear this in the paper all the time. But if you look at asking rent, and these are basically properties being listed, newly being listed, asking rent by landlords has come down pretty dramatically. So overall, the Fed is going to do a good job in terms of slowing inflation, but at the same time, they're being helped by disinflationary forces like lower food, lower energy, rent has peaked. Third positive reason why we think the second half of the year will be a little bit better is that this recession, the most heavily anticipated recession in the history of our country, will prove to be very mild. And there's 3 reasons. Number one, the labor market is very strong. There's so many jobs out there. So even as the unemployment rate moves higher, there's still a ton of jobs out there. Number two, housing. Housing pushes into a recession in 2008. We don't see housing being the same situation as it was back then. Why is that the case? Well, first of all, we don't have those funky mortgages that we had back in 2008. 90%, of mortgages today are either 15 or 30-year fixed, and they're amortizing. We have higher owner's equity within homes that does not create pressure for an owner to sell if prices come down. Yes, prices are going to come down, but housing is in a better shape. Inventories are super low. So you take all this together, we do believe that housing is in a much better shape than it was just back in 2008. And the third reason why we expect a mild recession is a concept that we call a rolling recession. So think about a recession. Let's go back to 2008. In 2008, we had housing really kind of impact the economy. Everything fell at once. We had a very steep recession. Then you look at where we envision a recession today. We envision instead it to be a very mild, shallow, rolling recession. So what do I mean by that? So if you look at what's in a recession today, housing's in a recession, autos are in recession, manufacturing's in recession. What's not in recession? Consumer spending. Consumers are spending like crazy. We're all flying. We're going to restaurants. We're going to bars. Capital spending is not in recession right now. As you start to see some stabilization in those areas that are in recession, like housing is starting to stabilize, manufacturing is starting to stabilize. We feel the other parts of the economy will start to weaken, like consumer spending. And we saw some recent retail sales numbers that suggest that consumer spending is starting to slow down. All this means together is that not everything declines at once, that the economy rolls through a very, very mild recession. This is our game plan for 2023. Again, a mild recession. So with all this said, listen, first part of the year, uncertainty. I know the markets are up, but lots of uncertainty around the Fed, around the recession, around valuations being pretty high, around earnings need to be revised lower. The second half of the year, we're very optimistic. We feel that, you've got the lowered expectations become easier to beat. You have the fact that there's inflation, the Fed gets the inflation story right. And number three, that the recession proves to be very mild. So with all this said, I just want to say thank you for listening. If you want more information, you can follow us on Twitter. My team is Cetera IM. You can follow me, Gene Goldman. And I really want to thank you. And I need to show you these disclosures as we kind of go through. And that's basically it. Have a great day, and thank you for listening.